Today's Talk About It Tuesday question is, what are the pros and cons of the 60-40 rule? Okay, so let's talk about what the 60-40 rule is first, and then we'll get into the pros and cons. So the 60-40 rule is an investment strategy, very conservative investment strategy that I think financial planners put together probably in the 1980s, where you invest 60% of your portfolio in equities and 40% in fixed income. So what does that mean? 60% basically goes into the stock market, meaning either individual stocks, mutual fund, index fund. Those are called equities, right? And 40% would go into primarily investment grade bonds. And it is a strategy that was designed to try to mitigate losses due to the economic cycles. The economic cycle is natural, normal, and will always happen, will continue to happen forever. And the strategy says that, well, the strategy is based on the fact that when equities are up, fixed income tends to be down. And when fixed income is up, equities tend to be down, so that you'll always have income no matter where we're at in the economic cycle, right? And so it's a way to mitigate. And I guess the reason for 60-40 is that equities pay a far greater return in general, right? The stock market pays a far greater return in general than fixed income. So it was a way to preserve your long-term savings or your long-term investment, and again, mitigate this. So I believe it is a very lazy strategy, first of all. And I guess people who just want to give their stuff to a portfolio manager and they give them the speech, it's a way to mitigate blah, blah, blah. They just went with it. And in the 1980s, it might have been a good strategy when interest rates were high. In the 80s and 90s, interest rates were really high. So fixed income actually paid pretty decently. And relative to today, the stock market, the returns were lower. So it was somewhat decent as a strategy. But then you have to remember, we went through a long period after the recession of extremely low, and I mean record low, I mean close to zero low interest rates. So fixed income bonds paid nothing for the last 20 years, pretty much. I don't know about 20, almost 20 years, because the recovery started 2011. From 2011 up until last year when interest rates started to go up. So you had a good 12, 13-year stretch of near zero interest rates. So if you have 40% of your portfolio in bonds, it made nothing. Literally, it made nothing because it didn't even beat the inflation rate, as opposed to equities, which has done extremely well in the last decade. So one thing we have to understand is that the world has changed dramatically. And I do believe you have to mitigate your risk by diversifying. But to have it in two things is not being well diversified, right? Two asset classes is not well diversified. So I truly believe you need to expand your asset classes. I believe even when you're talking about fixed income, we have to deal with all type of fixed income, which is interest income. So right now, high yield savings, money market accounts, crowdfunding, bonds don't really do well, but every other area where we can get peer lending, everywhere we can get a high return on fixed income, I think we need to be spread out in fixed income. And again, not necessarily 40%. I also believe that we need to have a variety of equities, right? So some individual stocks, primarily index funds, some mutual funds, some REITs, and then we need to be in other asset classes like real estate. I think everyone should own an investment property, or at least have some investment in it, whether it's through crowdfunding or otherwise. Everybody needs to be in real estate. I think that you can have some collectibles in terms of things that gain capital appreciation. Some people like precious metals, whatever it is, but there should be some there. I think that we should spread out in as many asset classes as possible. Now, what's the proportion? I think instead of being lazy because we have access to more information today than we ever had, is that we understand the economic cycle and understand what asset classes perform better during different portions of the cycle, and we just shift the weight of our portfolio to those asset classes that are performing well during that cycle, right? It's that we're always in every cycle, right? Because we never pull anything out, but during a particular phase of the economic cycle, we just shove a whole lot more in there. Instead of leaving profits on the table, we get as much as we can from that particular asset class at that time. And then as the cycle changes, we shift asset classes so that we get as much as possible during that time. And then when it shifts again, we keep shifting the weight, how much we continue to put in that asset class in our portfolio during a particular time. And that way we maximize profits and minimize the potential for loss, instead of doing if I have $1,000, I'm going to do $600 in equities and $600 in fixed income no matter what. That's crazy to me, right? Because if one asset class is going down, why would you keep putting money in that? Unless it just doesn't make sense to me, right? So we're going to take advantage of, okay, we're going to shift the money into the asset class that's winning at the moment. And then again, as the cycle changes, we keep shifting. I think it's a much more profitable strategy. I think it's also a safer strategy for mitigating losses. And there's no reason we can't do it now, because we have access to more information than we ever had. We don't have to leave it to an expert to tell us what's going on with the cycle, to tell us what's going on with different investments. The barriers to entry are lower than ever. So is it 60? Okay, so is there an advantage to the 60-40? Yes, if you want to just be lazy, right? And I guess you just want some kind of average, that's the advantage. You don't have to think about it. You don't have to do anything. You just set it and forget it. The disadvantages are you're going to leave a lot of profits on the table, and I don't really think you're protecting your portfolio from losses by doing it that way. I'd love to hear what your strategies are, what your thoughts are on the 60-40 rule. I think it's obsolete. I think all those fixed rules for investing, especially age-related investing, I think are obsolete. But again, I'd love to hear your thoughts, your strategies. Please like, share, subscribe, keep the questions coming, and I'll see you next Tuesday.